This is Rob Barnett. I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. We're joined by our regular cohort of Bloomberg Intelligence analysts this week. So we've got Salih Yilmaz dialed in from Dubai. We've got Hares and Patricio Alvarez and myself here in London. And we've got Fernando Valle joining from the New York City metro area. There's been a lot of really interesting developments in energy markets this week. First, we got the new energy outlook from BP for this year. And if you haven't seen it yet, I highly recommend taking a look and trying to unpack what's in it. But the broad summary that I would give from it is that they see oil and fossil fuels generally declining in usage over the next few decades. They see a meteoric rise in renewables, including wind and solar. They envision increasing electrification across many segments of the economy, including transportation, and they see a big role for hydrogen. So very interesting report. And I think we would like to unpack some of that here today. Also, at the same time, we saw a really interesting new bit of analysis out from Ember Climate here in Europe that showed last year renewables, wind and solar, outpaced and provided more electricity to the grid than gas plus coal combined for the first time ever. So very interesting bit of analysis. Elon Musk actually tweeted about that, which was quite interesting. He basically said something to the tune of the idea that wind and solar plus battery storage would help move the world toward sustainable energy. And then with all of that in the mix, we saw a very interesting bit of reporting out from the Wall Street Journal this morning, talking about how BP is maybe actually reconsidering its stance on renewables. So let's dive in. Hares, you cover BP, so I want to come to you first. What do you make of the reporting that we've seen from the Wall Street Journal, and how do you square it with both their outlook and some of the trends that you're seeing unfold?
Yeah, thanks, Rob. So I think it's really ironic, actually, this reporting from the Wall Street Journal that BP is reconsidering its renewable investments. I think recall just a couple of years ago, BP had specifically said that they were doing the opposite, so dialing back their oil and gas investments to increase their investments in renewables. So I think this tracks pretty closely with what we have been writing consistently about with BP's strategy. It's absolutely been the fastest of peers to adjust for the energy transition. Now, of course, this is in part due to BP's prior CEO, Bob Dudley, who was an old school Texas oil man who was pretty dismissive of the energy transition. And we had Bernard Looney, the current CEO, who came in just in early 2020 and put forth a reimagined strategy, which entailed a rapid reduction of oil production by the end of the decade of about 40%. And of course, this includes major divestments that the company made, including their entire Alaska portfolio, which is a big legacy piece of their portfolio. But then on top of that, we've also seen the risks that this accelerated energy transition strategy entails. First being the execution and profitability risk of pursuing this rapid renewable growth to almost utility level scale. And there was a deal in the Irish Sea where BP was bidding for seabed leases and just way overbid all competitors, almost to the point where the rest of the industry was laughing at them, almost ensuring a loss-making venture in the Irish Sea for BP. And so I think this just really reflects this slightly ham-fisted energy transition strategy that BP, I think, has almost felt forced to pursue, given that they have been a very clear latecomer versus their European peers, Shell and particularly Total Energies, who have been building up their energy transition portfolio, green portfolio, for a lot longer than BP has. And it's also ironic that BP was actually originally the first to pursue renewable power in a scalable way back in the early noughties, which if you remember ended up in a multi-billion dollars of impairments. So it is a little ironic that we're seeing this now, but not unexpected. We flagged this strategy as being too far, too fast, and carrying too much risk.
Fernando, I want to swing over to you. We've noted many times on this call the transatlantic divide between what the European energy majors are up to and what Chevron and Exxon are up to. What do you make of the BP analysis, and how do you think renewables fit into the strategy of an oil major or not?
It's a good question. I think it depends on their stakeholders, and I think that a big reason for that divide has been the stakeholders are inherently different. If you think about where the ESG movement really got its grassroots, it was the Netherlands, the Scandinavian countries, and so it's no surprise that Shell and BP have felt a lot more pressure to go into renewables than Exxon or Chevron in Texas, where Bob Dudley's from, to make that switch. So I think the returns are inherently lower. If you look at Equinor, if you look at BP, they've all said that the generation, their returns are inherently lower. They're utility-like returns, and for as much as credit as we want to give them for developing large projects, they haven't really. The recent track record for most oil majors, not just the European, hasn't been great in developing large projects in their legacy business, let alone a new business. So there are questions as to whether those returns are even attainable. But then more importantly, there's a difference in the dividend and distribution policy. Exxon and Chevron want to have an ever-growing dividend. Their shareholder base expects that, and their capital base is way too large to get those dividends out of a 7 to 9% IRR type of project. They need much higher returns. And that's why they'll keep going towards oil and gas or new technologies. I think it was interesting that BP was moving towards more carbon capture, more renewable fuels, similar to the vein. So in the Wall Street Journal report, similar to the vein of what Exxon and Chevron are doing. One last thing I thought was interesting that we saw this week, my former boss at Citi, Alistair Syme, proposed that Exxon and Chevron should actually buy the European majors, or I'm assuming just their oil and gas portfolios. It would certainly be interesting. I would disagree with him that there's a huge attractiveness to those portfolios. I think there are bits and pieces that make sense. Who wouldn't love Shell's Brazil portfolio or some of BP's regulated natural gas portfolio? But I think buying it overall is not the best, especially when they aren't putting enough capital into it and letting it decline by as much as 30% by 2030.
Very interesting perspective, Fernando. Thank you. Patricio, I want to bring you into the conversation. You look after our European utilities. Obviously, they are front and center in the energy transition. They've been making a lot of headway. And Will has even speculated that a European energy major may actually do some M&A that could be focused on a utility-like or clean energy-focused type player. So what do you make of both the BP report and the prospect for M&A in your space?
Sure. So I think the part that I would focus on from the BP report was was the divergence in their scenarios for gas demand overall. I think their net zero sort of scenario sees gas demand declining over the next few decades, and I think that broadly aligns with what European governments are aiming to do. So here in Europe, we are still under the regime of the Repower EU sort of target, which aims to reduce gas demand by more than 50% by 2030. versus 2019. So I think that's important to note that probably BP's scenario aligns in its most aggressive form to the European side of things, while I think the other two scenarios are perhaps a bit more realistic in the sense that they are perhaps collecting the fact that most developing nations are still using gas as a key vector of decarbonization, because that's a clear substitute for coal, given it pollutes right about half, emits half of the emissions, and is really easy to procure. And now it's becoming increasingly easy to transport with the advent of LNG supply, which it's also part of the Europe's sort of pull to diversify away from Russian gas. That sort of is already reverberating in a revival of LNG supply as well. So pretty interesting take. I'd say gas demand. I'd say I'm not sure if we've seen the peak globally, but it seems we may be near the peak here in Europe. At least that's what the policymakers are aiming to towards. And in terms of the M&A piece, I think it's very difficult, I'd say, to see. I'd say one good way to say it would be that my company's the European utility space is relatively stretched in terms of finances. I think both the run up in inflation and the run up in interest rates in the latter half of 2022 has affected the value of these assets, of the renewable assets, and it has constrained the financing headroom for my company. So we have already seen large integrated companies slow down the pace of their capex and announce that they will flatten their dividends rather than grow them. So that does set the stage for a liquidity event for some of them. I don't know if there's perhaps scope for like I don't know, a multi-billion deal in terms of like one of these companies getting fully acquired, but there will be a headroom for asset rotation and for farm downs for sure. And the other trend that I think it's important to note, and perhaps one of the main risks to an oil major coming in and taking in a big player in the space, I think it has to do with regulation. I think there's a big push here in Europe for utilities to become re-regulated. Or to become more regulated, and we've seen that already sort of come through with Germany's nationalization of Uniper and a couple other utilities. We saw France nationalizing EDF as well. So I don't know if that's a risk that the oil majors will be happy to take on, but there could be select opportunities within the renewable space, I think.
Okay, thank you, Patricio. On the M&A front, there was an interesting piece just the other day on GM getting into the lithium business. So not quite an energy play there, but it does seem like all kinds of entities are interested in the energy transition these days. So with that in mind, I want to come to you, Salih. Two things I want to get your reaction to. One is the role of gas in the energy transition. We hear a lot about that, particularly from your region. And another very interesting piece of the analysis from BP shows that through time, in all the scenarios they considered, OPEC's share in the oil market goes up dramatically from where it is today. I think you've been hinting that this is likely, but how do you see OPEC's share and what's the role for gas? Thanks, Salih.
Sure. Thanks, Rob. So on the role of gas in energy transition and what's kind of happening in the Middle East, we know that players like Saudi Aramco, ADNOC, the biggest NOCs in the region, these are huge players already in oil. Saudi Aramco produces more than 10 million barrels per day at the moment. That's more than 10% of the global supply. But we know that they want to expand their gas production as well. And actually on the ADNOC side, they are actually planning to list their gas unit in the next couple of months. And they are certainly in the school of thought that the demand for gas will increase. They seem to believe in continued growth in LNG trade as well. So they definitely want to be a bigger players on that front as well. So Again, I don't know what they would think about BP's outlook in terms of the gas projections, but they seem to be a believer in increased gas demand. And I mean, with that in mind, in oil as well, because as we've discussed multiple times on this call too, they are doubling down on expanding their oil production capacity as well. Talking about Aramco, we said they're producing just above 10 million barrels per day. Their capacity is actually, I mean, the nameplate capacity is around 12 million barrels per day, and they are investing heavily in the next few years to increase that to 13 million barrels per day. ADNOC similarly is investing heavily to increase their oil production capacity also by 1 million barrels per day before 2027. So I think this kind of plays into the second part of your question about how market share of OPEC is expected to increase, and that's what BP has you're right, in all three scenarios that they have. And this is in line with what we have been thinking and saying as well. It only makes sense because these companies, national oil companies in these regions, have been investing, didn't reduce their capital spending even through the pandemic downturn, and now are back to fully being committed to their legacy oil and gas businesses. So that's why they will be producing more. And I think the second part of the answer is, even when, and I think another interesting bit of this report was what happens to oil demand. And, you know, I mean, the BP thinks that in all their scenarios, they think that it pretty much peaks around 2025 and just goes down from there. We really don't know what's going to happen. But when demand does start coming down, this region and these producers, being extremely low-cost producers, are probably going to be some of the latest producers to actually be impacted in terms of how much of their production they'll need to perhaps trim. So I think there are many other regions with much higher production costs that will have to go first. So when you combine these two things, I think it only makes sense that OPEC, which is led by and dominated by these big producers such as Saudi Arabia and the UAE, which are investing heavily in oil production, that their market share will just continue to grow between now and 2050.
Thank you, Salih. Fernando, I want to come back in just a second, but I was going to offer a quick comment on just the rise of renewables quickly. So in line with the BP outlook, we're very optimistic about the continued growth of solar in particular. Wind's in a bit of a lull, but we see a lot of opportunity there as well. And one of the really big emergent themes, if you go back and look at our last call of December, I talked about this idea that 2023 was going to be a year where we really saw solar plus storage become a much bigger part of the narrative. Now, why is that the case? It's because the cost of solar has been coming down through time, and we've seen, because of the big run-up in natural gas prices in particular, we're now at a point where the levelized cost of electricity for solar plus storage is lower than the wholesale power price in many economies. We think this is going to be a big driver for the adoption of that technology. It's not going to be universal. It's not going to be overnight. It doesn't mean that solar plus storage is going to be the only energy solution, but we think it's going to play a big role, particularly here in 2023 and looking at the years ahead. Now, the way I interpret all of this, though, is that there's a tremendous build out of renewables, but obviously the world still needs plenty of fossil fuels for years to come. And so on that point, I want to come back to Fernando on just the idea of peak oil demand that you mentioned, Salih. So a number of the ways that the BP outlook got reported on, I think the FT kind of framed it this way, is that, you know, peak oil demand is in sight, that we're either sort of in this plateau or that maybe it's going to even start declining in the very near future. Fernando, we've gone on about this many times over the years here, but you know, where are you thinking about this topic here at this time?
Definitely not 2025. And there are several reasons for that. The first is it takes time for fleets to change, and EV sales are still only 1.5% in developed markets, once you get into the real growth engine of energy demand, it's emerging markets. And so you can't really offset loss in California it will be more than offset by growth in Delhi. So it's not apples to apples. And then, storage is to become a thing. We don't know how to mine for all the metals that go into that storage components without diesel. And so there's significant need for diesel in order to get to the to this electrification portion. There's a significant need for NGLs for all the petrochemicals and plastics because we need to lighten loads in order to make electrification possible. There's a lot of need for copper. So I just don't see we don't have the solutions today to get to peak oil demand by 2025 while shifting everything either. I just don't see how they equate the need for all these materials that require oil to gather and to process, and then to deploy them by 2025. And then I think, as you said, price is always a question. I think that's often missed because models can be a little bit linear, and demand goes down, when oil gets to triple digits or at least the acceleration weakens and China gets locked down, and then we're like, see, we don't need oil. It's fine. We're going to be good. And then when prices dip back again below 80 and China reopens, then we're left wondering what happened and why our projections aren't there. I mean, I'll just say, our colleagues at Bloomberg NEF do a great job with their EV outlook, but it hasn't been right yet.
Very interesting, always provocative, Fernando. By the way, I would note that Spencer Dale, chief economist at BP, has a standing invitation to come and join us. We would love to host him, and we've reached out. So let's see if he takes us up on that offer at some point. But Will, I want to come to you off the back of what Fernando just said. We're entering the 4Q earnings season or annual earnings seasons, however you want to frame it. You've got a note out this morning that frames what you think we're going to hear from the European oil majors. So give us a sense, how did we end last year, and what do you think's on deck for looking into 2023?
Yeah, so we think 4Q is going to be relatively strong still for this group. I mean, this is obviously coming off the back of record earnings and cash flow in 3Q for most of this, for most of the peer group. Obviously in large part driven by the record European natural gas prices, which we saw. But we expect earnings to decelerate a little bit. Obviously, we're seeing some softening of the commodity backdrop. Also, we're going to see the impact of European and UK windfall taxes to be relatively prominent in 4Q. We expect for Shell and Total, somewhere around $2 to $2.5 billion of earnings impact for 2022. This equates to 5 to 6% of overall annual earnings, and for BP slightly less. But so it's still material, and then of course the focus is going to remain on distributions, as Fernando alluded to earlier. We think that buyback programs can generally be held from 4Q into 1Q, although from year to year we expect these buyback levels almost certainly to decline from last year's record numbers, which we estimate to be $45 billion or so for the European group, and so we think that that'll land somewhere between 30 billion and 40 billion for this year, but. And then finally, of course, energy transition M&A is still high up on the docket. We saw BP close their acquisition of Archaea late last year, $4.1 billion for the largest American renewable gas producer. And so, yeah, I think that's probably another little mention from the top of the call here that is somewhat contradictory. From BP saying that they're going to dial back their renewable investments when they were the single largest spender within the European peer group on transition businesses last year, with green spending at over a third of their total capex. So we're going to be looking out for more energy transition M&A because, as you can see, we think this the transition strategies of this group are really a runaway train at this point, and at 20 to 25% of their overall capex. It's only been moving higher over the last several years, and we think it could be 50% or higher of total capex by the end of the decade.
Fernando, I want to come over to you. I know you've already had report outs from some of your names. How do you contrast what's happening in America versus what we just heard from Will? Is it a pretty similar story here in the short term?
Well, I think BP is moving towards where the US are. I mean, I think, well, correct me if I'm wrong, but the Wall Street Journal said they'll decrease renewable power generation, but they'll still do a lot of energy transition. So the RKAs and hydrogen and CCS, which is exactly where, you know, Chevron is playing in. For example, they bought Renewable Energy Group last year, not quite 30% of their capex or anywhere near that right now, and I don't think that will happen. But so far, I think what we've seen from earnings, it's been very positive from two aspects, which I think some of them the Europeans are exposed to. One, LNG lags a little bit, so that the drop that we saw in oil prices towards the end of the third quarter and into the fourth quarter hasn't really hurt upstream as much as was originally expected. Still much lower than the second quarter when we saw triple-digit oil prices, but overall pretty strong upstream. And then the real surprise was on the downstream side, where both in the U.S. and international, both majors did really well. Again, crack spreads fell, so everyone expected margins to drop off significantly. But one of the things that wasn't factored in was the widening of some of the crude differentials that helped those margins. And then there's been a little bit more demand than was originally expected. So the figures there have been were pretty strong for both Exxon, Chevron, Valero, Marathon Petroleum, and to a lesser extent, Phillips 66. The only one that's been disappointing has been petrochemicals, and it's been disappointing. It's been flagged. It's been something that has shown to be on the decline. And you know, if you think about just the timing, fourth quarter is probably pretty weak as far as demand, just because China in full lockdowns, year-end holidays, housing markets slowing with all the uncertainty in the U.S. and in Europe. So those margins probably got battered pretty badly, and not sure that you will recover right away, but it should stabilize from current levels at least.
Okay, thank you very much, Fernando. Salih, I want to come over to you and get your readout and expectation in similar fashion. Are you seeing a similar degradation in sort of the petchem space for some of your names?
Yes, I mean, there really isn't much to add to what Will and Fernando have already said. Again, for the European, some of the mid-sized integrated that I cover, it's a very similar story to the larger majors. I mean, the results are coming off of extraordinary levels that we saw in the second and third quarter. I mean, the pricing is just much softer. But then refining margins, as Fernando mentioned, what we've been seeing from some of the preliminary trading updates from companies like Galp, Repsol, MV, is this resilience in refining margins, which is surprising given, as Fernando said, that crack spreads have come down notably. Refining margins are still very strong, and I think will, you know, drive still solid results for some of these names. Again, I mean, I cover Aramco as well. I think it's going to be a very similar story there as well. In terms of petrochemicals, yeah, I mean, with the GDP growth kind of estimates fading away, I think the outlook for petchems, not just in the fourth quarter, but for this year as well, is really easing, especially compared to the really strong year that they had in the last, the last couple of years, really.
Okay, thank you, Salih. Patricio, I want to come over to you, get your readout from Orsted and just your coverage more generally, but let's start with them.
Sure. So, our earnings cycle just started today with Orsted. So I think, Important things to flag about Orsted is that it's a bellwether for the offshore wind industry. I think because it's the largest developer and also the developer with the highest returns on capital, at least the publicly traded, that is. Important to note that the company came in higher than 2021, grew EBITDA by more than 20% versus 2021. But the important thing to note, it was not due to its offshore wind business. It was more via its exposure to the run-up in wholesale gas prices, given the company has some CHP and bioenergy unit, so it benefited from that merchant exposure, and that kind of offset the weakness in offshore wind, where the company saw significant delays in its two largest builds last year. That was Greater Changhua in Taiwan and Hornsea 2 here in the UK. The delays in both projects caused multi-billion losses, given that the company already contracted the volumes and had to rebuy that power back at very high prices last year to deliver to its clients. So it kind of weathered, I'd say, a relatively rough 2022 with the upside that they farmed out a couple of their projects and still came in really strong in terms of proceeds and cash. For this year, the company sees a broadly flat outlook. And that means that, in our view, that there's less room for error in terms of delays or any sort of supply chain issues, because there will be no uplift from the exposure to elevated gas prices, given that we've seen wholesale prices sort of moderate, and we expect them to remain relatively muted versus last year when they were hitting record highs. And more broadly, looking into the rest of earnings, so we cover most of the gas and power European utilities, and we try to see, I think, summarize them by looking at the key bellwethers, which are the large integrated utilities, the diversified ones. So we're talking about Enel and Iberdrola. What we expect for them, and it's a sequential recovery from a very volatile third quarter, where spiking wholesale gas and power prices were resulting in increased, immensely higher sourcing costs for these utilities. We expect that pressure to ease in the fourth quarter and continue to ease throughout 2023. And we also expect them to fetch higher average power prices, given that they were able to lock in or sell that power forward. So these are two trends that we're closely watching, and in general, we do see a silver lining, perhaps, in declining gas prices for European utilities in 2023.
All right, thank you so much, Patricio. Just a quick advertisement for everyone listening. We hold these calls on the first and third Wednesday of every month. We're always delighted for everyone that can join us. We make the replay available afterwards. For our next one, we are going to be joined by Adeline Diaz. She's our Director of Research for ESG here in London. So I think, not that we don't talk about ESG matters, but we're going to have a true ESG expert on to really have a fun debate with us about the energy matrix and how probably some of the S&G factors that often we ignore. We often just talk about the E, so it'll be fun to chat with her next time. So that'll be February 15th. Hope everyone can join us for that. I would also just say everything we've discussed here today, you can find it at BIGO on the terminal, and there's a clever way you can sort of shortcut into our research. So if you've got the commodity for Brent crude loaded, you can just type BICO, and you can read the outlook from Salih, Fernando, and Will on where they see that going. Same thing for a company. You got the BP ticker loaded. You want to read Will's outlook on BP, just type BICO. Same for Exxon to read Fernando's outlook on that company. So BICO, great function. I hope you all use it. We're all easily found on the terminal, so just shoot us an IB if you have any questions in the interim. And we look forward to talking to you all again in about 2 weeks' time. So take care, everyone. Have a great February.